G'day listeners and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, I'm joined once again by my all-round good bloke and legend, Mr. Jimmy Ibrahim, mate. Welcome back to the show.
Are you feeling all right?
I'm feeling good.
Because that was a polite introduction. I'm just checking, just making sure before we get started, you feeling good?
What a dog.
There you go.
What a dog.
G'day, everyone. Welcome back to the show. good to see you,
Poke
Sammy
the bear,
boy.
you're going to get a bear of a response.
Good to see you, mate. You been
Mate,
well?
good to see- Mate, I'm doing very well, man.
Good.
I'm doing very well. And I'm excited because we've got a quick, punchy Q&A to round out the year. Everyone loves the Q&As, mate. We get on them regularly and everyone bloody loves them. So we've got a bunch of questions that we're going to punch through. We're going to try and round out a lot of the questions left over from the year's worth of entries. So,
I'm wondering whether or not our good friends are writing in.
I don't know.
Don't
They're
know.
your friends. They aren't my friends.
They are you.
Mate, let's get into it.
Let's get into it.
Last Q&A of
All
the
right.
year. Let's go.
First question from Sammy O.
Sammy O.
Yeah, Sammy boy. G'day, Bull Shark and the Silver. He's written dog.
Dog. What a dog.
We have just brought an owner occupied on the GC. In
Okay.
brackets, probably a shit deal from an investment point of view.
Love the honesty.
At least he's honest. But he said, but they wanted to enter the market and currently living with the in-laws, which is far from ideal, he says. They use the government 5% deposit scheme, so they avoided paying LMI. Now, they put in roughly $95K into the property as their deposit. Providing the bank has valued at the price they paid, does this mean we now have $95,000 of equity to pull out and roll into an investment property? That's the first question. He says, I understand there would be a 6-month wait till the bank would even look at a valuation. However, my partner is on maternity leave, so our serviceability is likely shot. Their long-term goal is to purchase a few
Mate, you're starting with a big one. Bloody hell.
Well, I just thought hit you between the eyes.
Yeah, easy.
So, yeah, basically their plan is to get a few more deals. They want to roll it into an owner-occupied home in the end, start building a nice little portfolio. So, curious. Do you want
They bought the owner-occupied
I
one.
know, but I think he wants to upgrade.
Oh, okay,
That's what he's written. They eventually want to get a better one.
He wants to upgrade. He should just rent vested.
Ooh,
If he hasn't got what if you, in my personal opinion, if you can't buy what you want as a primary residence, just rent vest until you can actually afford to buy it.
So you're hitting poor old Sammy boy
Sorry, mate,
between the eyes.
giving you a smack up around the head.
you've-
If the idea is to upgrade down the track anyway, that's my first thing. Second thing, just to get straight in there for
He
a
knew
bullshit.
you were going to rip into him because he said it's probably a shit deal from an investment point of view.
What's the point of buying? What's the point of buying it?
He
Just
tried
rent.
to tame the bull shark, but
Oh,
Sammy's
mate.
come straight out, Sammy. This is
So,
Sammy O.
all right. So your other big issue as well is like if you've paid market value and you're just hopeful that it's that's market value and the bank values it at market value, the $95,000 you put in as a deposit, that's your deposit, right? So like what you can pull out on top is the growth on top. If you've also gone in at 95% lend, you're going to need a fair bit of growth to be able to pull anything back out of this thing. I don't know the exact way the parameters work around the first home loan deposit scheme, whatever it is. My gut feeling is that you are more than likely going to have to save up, your deposit or growth coming through that exceeds probably what the government has guaranteed on the other side as well. I'm not sure exactly the parameters and the way it works. My gut feel is that your best bet is, I don't know how long it would take you to save up a deposit to get going again. But that is probably going to be in my mind, probably going to be the best option for you.
And it's fair enough, Sammy. Sammy O, who's written in, his wife is on maternity leave, so
Yes.
he's in for a bit of a longer stretch here.
Undoubtedly, yeah.
Okay, so hopefully that helped you, Sammy O. You're going to have to stick it out, mate. And maybe in 6 months get a val, see what it is.
See what it comes in at. If it comes in good, he might have a bit of ability. But realistically, I actually don't know the parameters around the lending around the first home loan deposit scheme. I don't have that much experience.
And
in
the
it.
last thing with this one, when his last comment is to roll into another owner-occupied home,
Yeah.
I'm starting to think he's going down the wrong track a little bit from an
100%.
investment perspective.
Yeah.
So
Look, the biggest thing I'd probably say is there's two things here. Either go back to the very start of Scouting Australia podcast and listen to the thing the whole way through. I'd probably say do that as well. The other thing is that if it is going to take you quite a while to be able to get ready to go again, at some point maybe you could look at, getting yourself to school or property bloody membership as well and getting yourself all skilled up in the meantime. Build out the strategy. Because I feel like he's a little off here. Like the fact he's gone and bought that one and then he's already thinking about the other primary residence down the track.
he's almost got two legs in each camp. He's
Yeah.
trying to hedge his bets, but And the 2 podcasts we did about primary place of residence
Yeah.
versus rent vesting and when is the right time to buy your house.
Yeah.
Maybe you should listen to those as well.
100%. I'll be going back and listening to that sort of thing because, it's in my opinion, you've probably jumped the gun there a little bit, buddy. And even if the idea for like down the track was primary residence, I would completely park that idea. If you have obviously bought the current primary residence, mate, I'd suck it up with that one to begin with. And then, yeah, man, be looking to start building the property portfolio on the side of that, the investment portfolio. That sounds like that's the real primary focus you should be going for. And then, we can have that conversation further down the track around, something else. But that should be longer term picture if anything to do with upgrading the PPR.
All right. There you go. That was Sammy O. Now we're moving over to Dave P. Cracking bloke from Adelaide.
Dave
Good
P.
fella. During your roundtable discussion, you touched on the idea of...
a fan favourite
That
app.
is your favourite. Lucky I brought that to your
That's a
attention.
good one.
Lucky that was my idea. You touched on the idea of moving on from the lower price suburbs in an area to the neighbouring ones which are at a higher price point, yet earlier in the cycle. Since the objective of bread and butter deals is to get solid capital growth in a relatively short time frame, and in brackets is written, which from what I can glean from the potty is anywhere from 70 to 130% growth, the question is, how far can a rising market move before you consider it too late to enter into that suburb?
Is this Dave P?
This is Davey P, because he's just come on board at APS.
Jimmy did tell me he had a question coming in from you, mate. So welcome on board, mate. Looking forward to working together.
Mm-hmm.
Now, the big thing, Mr. Davey P, is the biggest issue you have in that scenario is it is always area by area and case by case basis. And the reason for that is because of where are the house prices to begin with? Where are they? Where were they to begin with? Where are they now? And where are the incomes at? And where are the rents at? There's so many things at play here, plus the greater economy, what's actually happening in that region and in the economy that we're talking about as well. There are so many different layers and facets to this that you can't really, there's no clear number. Oh, well, if the market's going to grow 100%, we stop buying it 40% or 50% or whatever. There's no clear number because not all markets perform the same. So you have to really intrinsically understand the market, understand the affordability level of it, and then understand the metrics around it that essentially, can give you that data and give you that as a bit of a number in terms of how far we should still be buying into a cycle to leave enough growth left in the tank.
Okay, because he wants to be super aggressive. He's really keen.
Let's chat about this off air, Big Davey, mate, and I'll talk about it with you off air.
He actually
mate.
said in here, he goes, I got some big goals and I'm barking at the heels of the silver dog in terms of age range. So there you go, a fellow silver dog.
You'll catch him, mate. Don't worry. Don't stress. The thing's faltering. He's faltering.
All right, the next one, Bridget. Thank you, Bridget. Firstly, love the podcast and the passion Sammy has in property investment.
Thank you, Bridget.
And helping others succeed. And Jimmy sharing his story and vulnerability. Thank you, Bridget. My question is, can you explain the benefits of buying your investment property in a trust versus buying it in your own name? Which is better for bread and butter deals and which is better for cash flow deals that you may want to get rid of later on, whichever deal? Or is it a current market decision, like at the moment, more negatively geared deals are around? Thanks, guys. Love your work. What are you going to do for Bridget?
Bridget?
It's not Bridget Jones.
I love you as much as I love you.
How much do you love her?
I love her a lot.
Yeah.
She's an AP. She's a Scouting Australia podcast fanatic, it sounds like, and I love it.
She is.
I don't talk about trusts I don't talk about trusts. I don't talk about the lending structure, how it all works within it and everything as well. I feel like I've deflected. This is going to be the third question in a row I've deflected. I should have proofed these things first with what you brought to me.
I want to stump
I didn't deflect.
I want to stump the bull shark.
You're not stumping the bull shark.
Wow, just throwing it out there. Throwing a bit of burley and just scattering it.
School of Property. If you want the answers around that, go to schoolofproperty.com.au. Trust structures and lending within it and how to finesse that and work through that. Sorry, Bridget, I don't talk about that stuff openly to the public side of things. There's a lot of other people trying to steal my content out there with what they listen to, even with what we're doing as well with this stuff. There's a lot of stuff that I kind of keep behind closed doors in terms of what really took me to a different level, why we structure things in different ways, why we buy different properties in different structures, and why we do that in terms of how that allows us to keep moving forward as well. I'm sorry, it's not something I'm willing to go into.
I'm just my spidey senses just started perking up.
Is actually
Anon Smith is he started to fire up and saying, "Oh, come on, Sammy, give us the juice."
Yeah, Anon, mate, off.
off.
Anon Smith, Anon the
John,
Don, Anon John, all of you. Mate,
Okay.
there's your
But just-
corner. Go sit in it. Go face it.
But in terms of just the School of Property, how many episodes are around trust? So people know, is it comprehensive enough that good old Bridget is going to go in there?
There's a circa 2-hour episode with session in there with my accountant breaking everything down from that
Your
side.
personal accountant?
My personal accountant. There would be about 4 videos on finance within trust as well. And then there's probably around about another 5 to 10 videos within the greater course as well that has me breaking things down 100%. Like the how-to series, like how to build certain amounts of income. It's all within that.
Pretty
Mate.
comprehensive.
It is very comprehensive on that front. So it's like the School of Property is a 70+ course bloody video, mate. There is a lot of things in there. So yeah, man, like that's where you want all the juice, you want all the good stuff in that. I apologize, Bridget. You're probably asking me because one of the big things, obviously, don't go too much into detail around.
Because it's pretty detailed, isn't it? Like
it is. It's also like, yeah, man, you got to be careful with how you do it. You do it wrong, you can really, really stuff yourself up and cost yourself a lot of money with it as well, even with the setup and how you properly do it and all the rest of it as well. So there's a lot of things you got to get right to make it work properly.
Okay. All right. Well, there you go, Bridge. Sorry about that. But
School of Property. School of Property.
I'm trying to stump you, Semi. I'm trying to stump you.
Don't forget, guys, the code.
Easy.
SAP is the code, guys. Get yourself your discount. There's a few different variations there. SAP, APS. You could probably use all of them. PAS. No, don't use PAS. But
No. LBW.
No, that's you. Go on. Next question.
Callan has written in, Sammy boy, what is your opinion on investing in property overseas?
Oh, man, why do you keep hitting me with these questions?
The one I see as interesting is multi-family homes in the United States of America. God bless. Would love to hear your thoughts on this.
Why do you keep giving me these questions?
Just answer the question from the people. The people are asking you a question. Good old honest Australians want to know the answers.
I don't look at investing overseas. Here we go, 12 minutes in, we're 4 questions done.
Okay.
I don't look at investing overseas.
And can you just explain why? Just give Callan a little bit. The reasons why we wouldn't.
The biggest reasons, I understand the Australian property market extremely intimately. I know how to make money very well in Australia. There are a lot of things and hoops you have to try and jump to invest overseas. I looked at investing in America, maybe not 10 years ago. It was a long
GFC
time ago.
time.
I don't think it was that long ago because I didn't start investing till after the GFC.
Okay.
But I remember I had to look at it for a while there and just all the loopholes you have to try and jump through to make this thing work. There's so many moving parts to it. I prefer to invest in my own backyard. I understand how it works. I understand how to make great money out of it and make this thing work for you.
Yeah.
So I prefer to stick to the home shores of Aussie land.
Well, it's too much risk, isn't it? Let's face it. There's a lot of risk as well. And if you're not,
you're not a US citizen, like you know what I mean, like
the issues.
Yeah.
And there's a lot of sharks there. There's not only bloody bull sharks out there.
Yeah.
You're going to be careful. You do the wrong thing in the US, people will rip you,
mate. 100%.
Yeah,
see you later.
So maybe just focus a bit more locally, or
Mate,
seek it out.
You can make ridiculous money over here in property. Like in my opinion, you don't need to go across there to do really, really well out of it.
I think he's probably. Do you reckon he's referring to that guy who's broken the high yielding US deals?
Probably.
Yeah, so
Probably.
there's better opportunities here.
Oh man, like
especially when you want to cash out. Like, what are you going to do? You're going to have to
Yeah.
pay on the exchange and the tax. You don't know what the interest rate. There's so many variables.
man, there's so many
All right,
variables with
let's move on. So Cal, stay local, buy local, buy Australian.
Buy Australian, mate. Australian, mate. It's got to have a stamp on it. If it doesn't, we keep moving on. Like this bloke, I wouldn't buy this bloke. He's definitely not from Australia. Look at that. Look at that schnoz.
That was a bit British. You actually
No, it wasn't.
twanged a little bit. Tommy's written in. Hi, Tommy the Gun. Hi, Sammy and Jimmy. When it comes to installing granny flats onto a property, do you ever install portable ones that can be moved to other properties down the line? If not, why not?
Wow. Okay, so there's always got to be a reason behind it, right? So like, I have no issues with like prefab grannies if you can build them for the right money and they suit the area. And maybe your built grannies are extremely expensive, and your prefabs, like built on sites could be maybe $250. Maybe you could do a prefab at $150. Sometimes there's good opportunities and good reasons why we do it at that lower end. And yeah, man, there's definitely opportunities. So some areas where we buy quite early in the cycle. And man, sometimes we'll build build like a prefab granny on those things and hold them through the period of like ownership until maybe they're going through rezoning or they can be developed. And when they can be developed, we'll then go and move it and go and put it onto a different site. So we definitely have utilized that strategy before, and we do it a little bit. It really all comes down to what the long-term plan is. And the actual yield at the time. So if you can build and it's not that much more expensive to build, a a properly built, let's say a brick or a weatherboard or whatever on site, fixed location, fixed dwelling, on site. If it's not that much more expensive than prefab, I'll always go the fixed. But if the game plan is for future development potential, maybe you got a massive block but you want the additional cash flow for now, get you through for the next 10 years, really good cash flow stream, but then it gets rezoned or potentially, it could be sold on to a developer to be developed. You can then move that somewhere else, or you could sell it to someone else and be able to do it like that as well. So there's definitely options and opportunities around that too. But it's always a cost. It's a cost versus return, right? It's like if it's not that much more expensive to build fixed and you're going to own this thing forever, I would always prefer to build fixed. But if it starts blowing out to be like $60,000, $70,000 more, the rental return is not going to be like a few $100s a week more for that. Because at the end of the day, your prefabs are always at a bottom of the market. You know what I mean? So that product will always have a bottom of the market sort of, floor under it, so to speak.
Because the majority of the cash flow deals that we're doing, they're forever jobs. You're never selling them. So you might as well do it right the first time. Yeah. And then get the benefit.
Well,
right?
It does always depend. If the area has blown out and the cheapest you can build is like 220 plus, but you could do a prefab at 150.
Oh, that's huge.
And your rent on the dwelling is maybe like, I don't know, low fours compared to 350 for a I'll go with prefab every day of the week.
Yeah, 70 grand.
100%. And mate, a lot of those have massive length of warranties on them as well, because most of the time they build from like shipping container materials. Yeah, They're not saying we ever really looked at until build prices went crazy, but the prefabs pretty much stayed at the same price. Wow. So the margin became huge, but the rental difference didn't change much.
Why did they stay this lower price point?
Because they're a very easy and cheap thing to construct, and they don't need to construct them on site with expensive trades. It's not like they have big material shortages. They're very straightforward sort of things.
Okay.
So
and they come out pretty good quality wise.
Yeah. We've had some good ones. We changed to it around about a year, not fully changed to it, but we brought it into our repertoire around about 12 months ago. And yeah, man, it's worked well.
And this is the thing about knowing the numbers, right? And not letting your emotion of saying, I want to build a really nice place that I like.
I think it depends. If you're going to hold it forever and it's not that big a gap, then you would.
So it's the gap.
It's the gap. It's always the gap. Okay. And that's where it comes. Like you said, it's not about the emotions, about the numbers. And when you look at the numbers, if the gap is huge, it's worth considering. If the gap is close, you don't do it.
All right, Tommy Gunn. Hopefully you like that. Moving on to our next question. This is Jackie B. Jack
or Jackie B?
Well, he's just throwing a bit of a twang into it. His name's Jack B. It just doesn't have the same ring as
Jacko B.
Jacoby.
G'day, Jacoby. All right, what does Jacoby want?
Hi, guys. When we are doing rent vesting, I'm wondering when we should decide to buy a home. Should we set an equity position goal of when it's appropriate to buy a home? My concern for rent vesting strategy is that eventually we will have to buy a house, and does it make sense to get it done sooner rather than later when considering rising prices?
No.
He's trying to stir you up a little bit.
No, he's sweet.
No,
I know Jack.
Yeah. Oh, you know Jack?
Jack OB. I got a feeling who that could be. Bruh? Jack Bruh?
Yeah?
Yeah, I know who it is.
Yeah, okay.
He's a good bloke.
He's a great bloke.
I like him.
Yeah. He hasn't listened to the podcast, has he? About when should you buy your house? The podcast episode we did? When should you buy your primary place?
Like a few weeks ago.
But I'm sure you probably put in this question a bit earlier.
Yeah, probably. He probably did it before that. So maybe he already knows the answer. So let's go to the next one.
Yeah,
I'm only joking.
Recap. They should be listening to that.
100%. But to put this in perspective, so actually, just read out the last part of the question again, because I was going to say something and then you start talking.
My concern for rent vesting strategy is that eventually we will have to buy a house, and does it make sense to get it done sooner rather than later when considering rising prices?
Okay, so the compounding effect of like a multi-property portfolio, your one primary residence, the ability for that to outperform where you want to live, the likelihood of that outperforming a strategically positioned and a strategically built location-wise portfolio, the likelihood of that one primary residence where you really want to live being such a great investment location that it's going to outperform an entire portfolio, it's like 1 in a billion. There's almost no chance it's ever going to outperform on that side. So what I would be doing is building out the portfolio first. Once you finish building out the portfolio, then you come back and you can buy the primary residence. Because let's say if you're building out 150, 200K passive, well, that's the goal. We build out the portfolio to achieve it. And even if at the very back end, we need to buy it. And okay, maybe we have to go with a crappy lender to begin with because we've exhausted a lot of servicing. But if you're able to buy that primary residence, right, then over the next couple of years, as those bread and butters start to or they're going through significant increases, we're consolidating, we're selling them off at the peak, we're debt reducing a lot of the portfolio. Maybe it's part of your strategy. We throw an extra couple of deals in. It's going to be nice, big, chunky profits to go towards the primary residence. When we're going through this consolidation, we can start, like in that scenario, you probably would start debt consolidating the primary residence first. Then you're probably going to be able to refinance it back over to a really, really sharp rate and then start smashing it down as well. But what you've done is you've built the asset base first. It's going to allow you to go through a massive growth period. Now, and that's compounding growth, it's compounding rents, it's everything, as opposed to buying a primary residence that's probably going to massively stump your journey. And this is a big thing people don't realize. They're like, oh, no, I'll buy the primary residence first and then I'll build the portfolio. Like Shawnee or whatever it was at the very start, who bought the primary residence on the Gold Coast. He's hampered his ability now to be able to build and multiply his portfolio. He might have put himself on the sidelines for 1 or 2 years because of that. Whereas if instead, if he'd gone and then gone hard and multiplied his deposit across multiple properties, recycled equity and gone hard from that perspective, he could have built himself a really, really good portfolio and maybe in 1 or 2 years gone and taken that $95,000 and brought it back and again still done the same thing, or had even more, or potentially, he waits 3 to 5 years and goes, in 3 to 5 years, whichever property has gone up the most or that market's peaking out, I'll sell it down, I'll clear the debt, and then I'll use that, say 300 grand profit, I'll use that for my primary residence deposit and I'll buy it then. But in the meantime, I'm going to build a 4, 5, 6 plus property portfolio and set myself up in the meantime.
Because people are fearful of thinking, let's just say you could buy a house for 500.
Yeah.
And in 5 years' time, let's just say hypothetically, it's worth $1 million. You're buying in at an extra $500,000.
What are the chances of that? And if the chances of that are high, it means that your primary residence would be in a high growth location. So still invest first, because instead of buying one of those, if it's rising that rapidly, you probably bought 5 and you've probably made $2 million instead of 500.
So the reality is it's probably going to be 200 or 300 grand more if it's not a high growth location. Let's just say there might be a chance at best.
At best.
So even if you're buying at a slightly higher price down the line, the opportunity cost of not investing is far greater than just trying to save 200 grand.
100%. And that's why my example of like, you would have to be so unlucky for your area to all of a sudden be the best growth location in Australia. But you also take away your ability to multiply.
Yeah.
Whereas when you're investing, you can multiply that investment. Right. You can multiply the wins, keep building and growing it from there. So, man, for me, it's an absolute no-brainer. Build the portfolio first, come back for the primary residence at the back end.
Yeah. Yep. Fantastic. All right, mate, we're at the end.
Jacoby, mate, great question.
Well done, Jack. Thank you. This is from Natalie. Natalie's written in. It's quite a long one. Bit of a comment, then question. Hi all. First of all, thank you for providing not only an educational, but entertaining, humorous podcast. That's obviously my contribution.
Edutainment. That's my middle name.
Which I listen to.
Edutainment Gordon.
Which I listen to on my commute.
Jimmy. Jimmy. Come on.
Shut up. You're only 22 minutes in.
Yeah, I'm trying to stretch it out. You said we're almost done. I'm trying to stretch it.
So she says she listens to it.
Who's this?
Natalie, on her commute to work every morning.
Thank you, Natalie.
The problem she has now is that she's listened to all the content. I'll have to listen to something else.
You want some more content? www.schoolofproperty.com.au. Use discount code SAP.
70 videos right there.
70 plus.
I didn't listen to all the content in order as I jumped between apps of interest and really didn't expect I'd like what I would hear.
She must have seen your face on this little
tile.
Though,
once I saw Jimmy, I got hooked. No, she just said I got hooked. To be honest, the last episode I listened to was the one that featured Tara.
Oh, okay.
The four-legged legend.
She
was a legend. I too have 2 four-legged legends. Thanks, and Natalie. 2 amazing children. So the content resonated with me and made me feel even more confident in you and the team at APS.
Thank you, Natalie.
I'm super excited to say that I've signed up with the APS team to pursue my property goals. On a podcast, you'd mentioned how great it was having Morg speak of her journey and how it would be great to have more women on.
Here we go.
I'm planning to be a guest. Beautiful. And she's put in brackets, older boiler.
Oi, old boiler.
That's what she's doing.
Oh, I love it.
Oh, Natalie. She sounds like a laugh, doesn't she? Sounds like a riot.
Very good.
On the podcast, when I have some property success to share and talk about.
Let's go.
Let's park
Let's go.
that. Let's put that in the
note,
calendar.
I don't have a notepad, but
write it, mark it down, producer. Natalie, I can't say her surname. I was about to say her surname. So thank you in advance and can't wait till that day.
Love it.
And last of all, and my question.
Okay.
When looking at an area to invest,
yes,
besides yield and growth from, say, the previous 10 years, what else do you look for in the location? Ooh,
Natalie,
don't you dare.
What?
Don't you dare direct. Don't you dare.
I wasn't going to.
You were.
I wasn't
I could tell. You had that look in your eye. You were going to palm her off.
The look in my eye was palming her back off the Scouting Australia podcast apps where we've talked about like understanding data and growth markets, whatever it was. Look, the realistic thing, like obviously, you know, there's a lot of herbs and spices that go into us selecting correct growth locations, but there's a huge amount of additional things. So like population pressures, economic activity and spend. So
like infrastructure.
Yeah, I was about to say, like even from an infrastructure perspective, but what's going on in the local economy, like how vibrant is it or how dead is it? All those different things. You've got your population pressures. What's the actual inventory level? What's the stock level coming on? How much land supply is coming on, or how much of a deficit are all of those things as well? There's a huge array of things that we kind of go through the serious multi-point checklist that we go through for all this stuff as well.
The affordability indexes.
Yeah, I mean, there's so much involved with it. That obviously, probably the biggest thing I'd say is if you want a bit more in the nuts and bolts of it, whatever that app was, which was understanding growth markets or whatever it was probably about 6 months ago that we went through that in detail. That is probably where you'd look to go through and unpack within that episode as well. Or if you want a more detailed, there's other places.
What other places are you thinking of?
That have already been mentioned on the schools. There's schools of property, I think, that teach this stuff. Yeah,
never heard of it.
.com.au.
Bugger, never heard of it. No, but to be fair though, this is, and Natalie, it's a perfectly legitimate question.
Yes.
So if you can imagine a big sieve of like metrics and they're all filtered in and there's all the suburbs, you're obviously trying to isolate and identify a core group of areas that really hit a lot of the high notes of what we're looking for. And
it's a great analogy because you're throwing the sieve, you're going through it and you're knocking out all these places that
100%,
don't meet the criteria,
100%.
that don't tick it for whatever reason as well. So
now for Sammy to give you the full herbs and spices, I mean, that's what the intellectual property of why people pay a fee to engage a service. So you got to protect that. Otherwise you'd be basically giving yourself, you'd be out of a job. So basically that is one of the main reasons, to be fair, why people pay a fee
100%
to someone to execute
felt like
that.
More than half the questions you asked me today were reasons like it was like IP that we can't really give out as
I was just testing you out. Okay. See what you throw. And you failed to deliver again. No, you did well. You did well. You know what? We said we're going to do it under 30 minutes. I don't think we've ever done an ep under 30 minutes before. We haven't. There was one from Manon, but I didn't want to bring it up because I didn't want to get you upset.
Go on.
No, I don't want. I'm going to roll you up right at the end.
Because that's what you normally do?
No, better not.
All right.
Well,
for you to not do it, you don't have a question for Non.
I do.
Go on.
No, he said this is from Manon Smith. Back to the OG.
The audience will be disappointed if it's
Sammy boy.
Yeah.
Thank you for putting out some great content. I've noticed that you've now produced an education course in quotation marks. He's put.
Yes, Anon. That is correct. You fool.
Is this another way for you to fleece the Australian people of their hard-earned money? Not only have you been flogging these blue chip locations, but now you're feeding us some rabble about your so-called expertise.
I'll feed you something, Anon.
His last thing is,
feed you something.
Give us a break, Sammy. Give us a break of your rabble. Can we really believe that this is going to make a difference to the bloody good old Australian people?
Anon, is there anything else?
No, that's it.
He hasn't even signed it off.
Nah,
Anon who?
It's Anon Smith.
Oh, Anon Smith's
back. He went back to the OG.
Anon Smith's back.
Because I think Anon Smith got upset that Anon John and Don were trying to supersede him.
Wasn't there another one as well?
He's the OG.
There was another one, Anon Tom or something?
No, not yet.
Anon Tom didn't come yet.
Yeah, you created a copycat.
Jesus.
You created a copycat.
Jesus.
But Anon Smith, he said, I am the OG.
Right. Anon, easiest way to put this. Mate, send in your portfolio. We're going to compare it against mine. And then let's see who should be giving the education and should be talking about this and who shouldn't.
Okay.
Send in your portfolio, Anon. I'll have a look at it from a non-biased opinion. We'll actually let the APS team, we'll let them have a look, assess both portfolios. And you know what we'll even do? We'll wipe out the last 3 years from when I won Investor of the Year in 2020.
Yeah.
Let's compare your portfolio until that portfolio there.
Okay.
And let's see. Let's compare, mate, and see who's up.
All
And
right.
and mate, if yours beats me, all good. I'll pull it down.
Okay. Wow. So you're going to pull down.
That is how certain I am that Anon the Don or the dog or whatever his name is,
Smith.
has never even bought an investment.
Well,
and he's sitting there going, "Nee." Like, what's he bringing to the table except for dumb questions?
Well, he's basically asking,
Some
are
idiot-
you giving value to the people? That's what he wants to know. Are
Anon,
you giving honest value to the...
You've got, what's the date today? It is I think it's the 11th or something like that. Mate, you've got 13 days to sign up and use the SAP discount to let me know if it's worth money or not. You idiot.
20%. You managed to get the 20% discount in
Do you
there.
know what? I'm going to take it. I'm now, sorry guys, the discount code is now gone because I do not want Anon to get the discount.
Anon Smith is... No, so what you're saying is there is value. Just to put Anon Smith's mind at ease. Just put him to bed.
And on, mate, the day that you hit the portfolio size mine is, mate, then, mate, it's all good. You can tell me to pull it down and it's not worth it. Until that day comes, or until the day where you get within a tenth of what I've done in my portfolio, just in the investing side of things, and started from where I started from as well, mate, that's when you can give me advice. But until that day, buddy.
So you want to measure your size with Anon Smith size?
I'll measure a small portion of my portfolio against whatever this being has seems to.
I didn't want
to.
I knew that I shouldn't have brought it up, but I'm glad that I did.
Why?
Because just to see, I'm speaking on behalf of the people here. This is the people.
He's not the people. He's a dog.
Well, he's part of the pack. The silver dog, the non-dog.
Non the dog.
Anyway, that's it, folks. We've just cracked the 30-minute mark.
We were struggling there. We were really pushing to get there today, guys.
We really stretched it out. But we got there. Hopefully that gave you a bit of value.
Guys, I hope you enjoyed the potty. Jimmy was terrible as always. Delivery of questions, choice of questions. Surely we have some better questions out there.
Are you saying that these people who wrote in
that you should have
giving
replied
valuable
to
questions?
the emails
Is that
and
what you're
said,
saying?
thank you for the question. It is probably not all that relevant
You know what you've
within
just done?
this Q&A.
You just created a whole bunch of anons.
That's fine.
Because they're furious
That's
that
fine.
you've put down the
I
people
love
that are
everyone
writing in their
that's written in
bloody
here.
questions. It's un-Australian.
Everyone that's written in here except for Anon, I love yous. All of you.
I love yous all.
I love yous all. As a wrap up from that, I think we're done. I think everyone's sick of hearing of us.
We're done.
Guys, I hope you took some value. I don't know if there's any value within that.
Absolutely
at
was.
all. I hope there was. If you took any great value, make sure you hit the subscribe button as always if you haven't yet. And if you haven't sent this on to anyone else, or if you think anyone take great value from anything in this episode, please make sure you send it on, share the love. If you haven't left us a 5-star review yet and you're loving the potty, also please jump on and leave us that 5-star review. Anything else, guys? Any other questions? We need some more questions sent in. We need more for the next Q&A because that was dismal.
Stump Sammy, folks. Stump Sammy.
I love you all. We'll be back next week for the final episode of the year. Hold your hat, folks. It's a big one. There's something you love that was released a few months ago, and we're bringing this thing back to the table as a sign-off. See you later, Jimmy. Thanks for coming in, mate. I'll catch you guys next week.